Hello and welcome to Killik's 2017 equity themes. 2016 was a very strong year for the equity markets, with many of the indices ending the year near record highs. And this is despite a number of macroeconomic headwinds that the markets faced. For instance, there were fears over Chinese economic slowdown at the beginning of the year. Around the middle of the year, there was the UK's vote for Brexit, and then the US presidential elections towards the end of the year. So what about 2017? Well, we continue to believe that thematic investing is the best way to search for opportunities. And our three key themes for 2017 are cybersecurity, defense spending, and infrastructure. Cybersecurity is very pertinent today, as Yahoo has just announced what's likely to be the largest ever data breach, with around 1 billion accounts having been accessed. Information such as people's names, email address, telephone numbers, and birth data has been accessed by the hackers, as well as encrypted versions of the passwords and encrypted security questions and answers, and also unencrypted security questions and answers. They've also said that forged cookies may have allowed the hackers to access accounts without even using passwords. So cybersecurity continues to be a big area of spending, and the number of cybersecurity events have continued to increase despite this big pickup in spending. So you can see this massive increase that we've seen in events, and over the same time period we've seen a significant increase in cybersecurity spending. In 2015, cybersecurity spending was around 100 billion, and we expect that this will continue to increase at double-digit rates over the next 5 years. And that the reason for this is what we would call a perfect storm in cybersecurity. So it's basically more users, more data, bigger networks, more devices, especially smartphones and tablets, and other areas such as cloud computing. And this has been combined with more attacks, clever new malware, and increasingly sophisticated actors, including organized crime as well as state-sponsored hackers. And we feel that this will be driving the level of spending that we expect. Why is spending on cybersecurity important? Well, it can affect your reputation, it can result in fines if you have breaches, and it can also affect your business from an economic point of view. And just an example, this chart just shows TalkTalk's net customer additions and what happened here after they had a cyber attack that resulted in the breach of user records. Their net additions fell off significantly. So spending on cybersecurity is very important. How do we think you should play this? Well, we think the nature of cybersecurity and the technology involved makes it very difficult to predict which company will be the individual winner. And so we think the best way is to play this through an ETF, which gives you exposure to a portfolio of stocks. And here we are recommending the iSpy ETF, and you should speak to your broker for more information on that. Moving on to defense spending. So here in the US, defense spending peaked in around 2010, and since then it's down around 15% or around 100 billion. And while spending is forecast to rise, we do believe that it can increase even further as a percentage of GDP. This is the current budgeted increase in defense spending, but if you look as a percentage of GDP, it's continuing to fall. So we believe that there is potential for it to be increased beyond this budgeted level at the moment. And this increase in defense spending will be driven by things like Russia and China modernizing their armies, increased proliferation of next generation weapons, the nuclear ambitions of North Korea, and increased cyber warfare. There's also been comments by the President-elect Donald Trump that he intends to modernize many parts of the US Army. Our pick in the sector is Northrop Grumman. It's got significant US exposure. It's also exposed to those areas that we expect there to be an increased amount of spending going into. It's a leader in areas like stealth technology and autonomous aerial vehicles, and is a very strong player in cyber warfare. final theme is infrastructure spending. Infrastructure spending has been falling in the developed world, and this has resulted of much of infrastructure being in poor repair, which impacts economic growth as well as safety. And here we can see what's been happening in the US. So this is US infrastructure spending as a percentage of GDP since 1960. And you can see this incredible decline as a proportion of GDP over that time period. We do expect there to be an increase in infrastructure spending now underneath the President-elect Trump, and he's talked about spending up to $1 trillion in infrastructure spending. And the benefit of this is that it's expected that every 1 billion of infrastructure spending will create 13,000 jobs, and also that it results in around 1.6 billion of GDP in the following year. So it's very beneficial to the economy. Our picks in this area are Ashtead, it's a leading US and UK rental company of tools and equipment that get used in construction. Also Heidelberg Cement, which is a player in the cement and aggregates business with big operations in the US and the UK, and then also Hill & Smith, which is involved in infrastructure for road as well as galvanizing of steel for infrastructure projects. Thanks very much for listening.
So as we approach the end of the year, we look at several funds which investors could look at adding to their portfolios in order to tackle 2017 ahead. The first of which covers the idea of factor diversification within portfolios. Donald Trump's US election victory has brought about quite a shift in investor focus over the recent period. Markets are now questioning, following several years in which expansionary monetary policy has been the primary support mechanism, whether now fiscal policy is the primary tool in order to spur growth. Some economic commentators have moved from talking about deflationary pressures to now the idea of reflationary themes. Whilst it's far too early to decide whether this is a complete regime change for markets, it does emphasise the need for potential diversification benefits in portfolios. And the reason for that is, following on the election result, we've seen a notable dispersion in sector performance. So following several years in which more defensive growth areas have outperformed, more recently the value sectors, the likes of the financials, the miners and the materials sectors, have really led the way, following rising bond yields. With that in mind, at the very least, I think it emphasises the need for style or factor diversification within portfolios. And in that context, the first fund that we mention is the Schroeder Income Fund, our favoured manager for exposure to that value factor within the UK market. So the next topic is related to looking at lowly correlated investment strategies. Whilst markets were very resilient during 2016 in being faced with quite notable political events, there is continued heightened political uncertainty moving into 2017 as the outcomes of both Brexit and the US election result comes through, and also a very busy European election calendar. It's also difficult to ignore that the current business cycle has extended in the US for more than 7 years, and that does, on a historical basis, does look somewhat stretched. And all of that does emphasise that lowly correlated investments within portfolios is certainly attractive. Another feature is lack of correlations in markets have lowered in more recent time, and if that trend continues, it does lead to a more attractive opportunity set for long-short managers. And so we highlight in this context market neutral strategies, so where the long portfolio is weighed out by the short portfolio. And in that area, we favour the Old Mutual Global Equity Absolute Return Fund for exposure to a market neutral, lowly correlated investment strategy. So the next topic is on sustainability of income. So after the political events of 2016, we have seen rising bond yields and inflation is now being talked about in much more detail. Whilst it's far too early to say whether the fiscal stimulus measures will come to fruition and lead to an increase in inflation, it's important to look at the context of that in portfolios. And we believe focusing on sustainable and progressive dividends is important in this environment. We highlight two funds in this space. The first is a listed investment company called 3i Infrastructure. This invests in a portfolio of unquoted infrastructure businesses in largely regulated industries and offers a largely inflation-backed and long-term income stream. The second is in the property space and is London Metric Property. So this is a London-listed REIT, and this is more recently focused itself in the distribution and logistics space. And the attraction of that is it's structurally backed by the trend of increasing consumer demands in terms of retail and online delivery, and also the income streams are long-term leases. And largely, or there's a contractual uplifts built into them, and so that leads again to a sustainable, progressive and long-term income stream. The last theme is on healthcare innovation. So the last decade has really seen a vast amount of progress being made in a number of areas in healthcare technology. The likes of DNA sequencing, gene therapy and immuno-oncology have been extremely changing for the sector. The UK and Europe is really leading the way in terms of academic research in these sorts of fields. However, in terms of long-term finance compared to the US, long-term finance has been well below that of its US peer. And that's led to a much lower number in the number of businesses reaching commercialisation coming out of that academic research in the UK and Europe. One company that has looked to benefit from this lack of financing but opportunity in terms of research is Beckett, and the Battle Against Cancer Investment Trust. And this company recently changed its investment policy in order to enable it to expand its ability to invest in life science investment companies. This will be a process which will happen gradually, but I think the opportunity set for them and the team that they've recruited in order to do that is a compelling one, and leads us to this being quite a compelling investment opportunity in the life science sector.